Hunting for excesses in the financial system with AI's help. That's what our chief equity strategist and economist John Blank has been doing, and he's here now to discuss his findings. John, you wrote recently these are frothy times for financial assets. They're referring primarily to U.S. stock prices, or is that indicated elsewhere in the financial system also?
Well, certainly in large cap U.S. equities, S&P 500 trades at 24 times earnings, which typically trades around 18 or 19. So you got a 25 to 30% overvaluation relative to just the last 5 or 10 years. And in a recession context, it can go down to 14, which would be a 50% overvaluation. But a lot of it's be driven by Bitcoin. Bitcoin is now $120,000 for Bitcoin, and before this particular run, it was down to 60. So we've got to double your money running this halving of the Bitcoin. That's buried into that momentum stock trading and everything else, because the Bitcoin companies that are listed often trade at 3.5, 4 times market beta. So it's a high beta momentum trading market, and Bitcoin's a major part of that high beta story.
Jen, why, I have to ask this, why did you use AI to uncover these excesses? Were they not readily apparent otherwise?
I think AI is the story of this market, Terry. So I wanted to use an example of something that has captured the fascination of the market in my writing. And the thing I found is with AI, when you consolidate what it provides you, it gives you a narrative, not the narrative, but a narrative. And I found it useful to supplement it with being an economist. And I generally found, if you're looking for something quote unquote neutral, at least you can say, here's what AI thinks, not what John Blank thinks.
So, has your findings maybe created a wall of worry for you?
Well, that's what I just put out there, and since I've written this piece, the stock market's done nothing but go up, and that's exhibit A of climbing a wall and worry, because this is often the case where people are out, pointing out, the headwinds of a market, and the market's just climbing over them and pricing them higher and higher. This is often the case, Terry.
What potential situations then can occur as a result of these excesses?
What can happen, Terry, is we have a disconnect between the real economy, which all the growth estimates have been snapped in half, with a stock market that's riding to very, very high valuations. And this is a wedge that keeps getting wider, and the correction gets that can potentially result out of this can be much more violent than most people understand.
Sounds like a lot of uncertainty surrounding this data. Is that what your main concern is?
Yeah, I mean, the basic problem with any uh, estimate going forward in this environment is, we're seeing those little high beat rates in the second quarter, both revenue and earnings growth. People are, coming lowballing numbers and then coming higher, on the way through it. But in truth, the numbers are lower even with those beats baked in. And that is the story here is how do markets react? Like we're seeing through this earnings cycle, you get a very modest for upside for most beats, and if you miss, like IBM did today, or Tesla did, you really get pounded in this market.
Is there any way to remove these excesses from the system?
Only a recession, Terry, or a big pullback will do that. And markets forget that macroeconomic cycles have three components to them. They're interdependent. They're not independent. But you know prices can go out dramatically, which will keep the volume adjustment less. Volumes and unemployment could go up dramatically, which will come along with lower prices. Or it just can be a quality adjustment, just buying less, buying cheaper things, or all of the above. So I think in this uncertainty, so far it's been a quality adjustment that's been very, very creeping, and a volume adjustment that's pushed further and further out because of the importing that happened the first quarter. And we've got to see this price adjustment, and that would be the thing I'd worry most about.
Regarding stocks, a lot of people have been comparing the current situation in the stock market, near all time highs, to the internet bubble of 2000. What say you?
Well, the difference here is, we have massive companies, effectively oligopoly companies, if not monopoly companies, that have, managed to capture a massive amount of profits versus 2000. And the other thing is we have a lot of the financing of the IPO level is done by private equity now, not issuing stocks like the internet bubble of 2000. So that's kind of the good news here. And the other thing is the price earnings multiple that I talked about, 24, was actually even much higher back in those days too. So it was a much more inflated situation than this one. That's kind of the good news. The bad news is, the growth situation here, because the tariff thing is much lower. So, it choose what side you're on the market, which amount of that picture you want to see.
So then, against this backdrop, what's your advice to investors?
Investors, I think, should be building cash and selling stocks at these highs. Traders, can play in a day trading game and do quite well through the momentum until it's over. But I would tell investors that now's the time to pile up some cash and take some winners off the table, because it's a situation that at least you're in can play both hands in the market, which is keep some stocks for the run and keep some stocks for being able to deploy cash at much better valuations when a correction comes in.
Been noting a lot of aggressive share price charts across the strong buy list lately. Stocks in that category include Northern Trust, International Consolidated Airlines, and Geely Automotive.
Yeah, let's talk Northern Trust, ticker NTRS. You and I know this stock. It's a bastion of the Chicago regional economy. Just to get an example, during the sell-off, it went down to $90 a share. And now, literally 3 months later, it's close to $130 a share. So that's a $40 share price move in 3-4 months. So what do we got here for a value score? F. VGM score of value, growth, and momentum. F. Did you have? We do have a number one rank on this stock because it's up. The estimate revisions are up 4% this year. But when a stock moves up 30% in 3 months on a 4% move in annual earnings, you can see my concern of an overvalued stock in a momentum trading situation.
What about International Consolidated Airlines?
Yeah, this is British Airways. And again, this stock during the lows of just a few months ago in April was $6 a share. Now it's 10. $6 to 10, you had a 40% move. However, in this case, there's still value in this trade because people are scared of the airlines. 7.8 PE valuation, and you've got a really nice looking movement in travel generally. So again, I would be selling this stock, not buying it. But if you get a pullback to the 7s and 8s area off the next go around with the stock, I'd be looking into it.
And Geely Automotive.
Geely Automotive is a name you probably don't know, ticker GELYY. This is a Chinese electric vehicle company, not as well known as BYD, but it is one that actually makes a lot of money, Terry. It's a $4.30 a share earnings this year and $5.80 next year with 11 PE. So you can buy this stock at $48 a share with a $4 to $6 underlying earnings for a year. This is the most attractive stock from an investing perspective right now, and it is the number one ranked stock with 11% upside revisions this year, 13% next year. A for growth, A for value, B for growth, A for momentum. The only issue you have here is it's Chinese listed, but otherwise it's a fantastic investment opportunity.
Our chief equity strategist and economist, John Blank, on excesses in the financial system. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.